Hello everyone, welcome to Aptera Owners Club. This video is about investing in Aptera, and I thought I'd do this video because this funding round for Aptera is going to end in about 2 weeks on December 31st. So I thought it'd be a good time to go over it, kind of go through the process and let you guys know how it works and how you can sell your shares and what the tax implications are and that kind of stuff. All right, so before we get started, I want to make a few comments. Number one, I am not a finance professional. I don't have any specialized knowledge or experience in IPOs or venture capital or investing in startup companies. So if any of you guys that are watching have this kind of information, please comment below and give us your knowledge and correct any mistakes I make in this video so that we can all learn. Number two, if you're going to invest in Aptera, you have to understand that it is a very high risk investment. There is not a negligible chance that you will lose all your money and everything that you invest into Aptera. If the company does not produce a vehicle and is not successful, more than likely they will liquidate or go bankrupt, and you will lose your entire investment. It will be essentially worthless. So this is one of these quintessential high risk, high reward investments. There is a potentially pretty large upside given the valuations of EV stocks these days. However, there is a not non-zero chance that you will lose everything. So I definitely would not invest money that you can't afford to lose. I would only invest money that you would be okay if you lost every last penny of it. Okay, so that being said, let's get started. We'll go through the process together. First, you go to invest.aptera.us, and then there's two buttons here, FAQ and sign up to invest, and there's a thing that says view offering circular. Okay, so we'll be looking at this circular. It's about 40 pages long. I recommend that you do read it. We'll highlight some important points in there. And then, the first part of this video, I will talk about the things that I am pretty sure, almost certain are true, and that is how things work. And in the second part of the video, it'll be some speculation of how I think things work, which may be completely wrong. All right, so the rest of this page has a bunch of information that tries to tell you why they think that they're a good investment. And then, yeah, here's the perks. If you invest over 1,000, and 1,000 is the minimum, you get $100 off of your Aptera. And then if you invest over 10,000, you get the $100 coupon and a 5% discount on your Aptera up to $2,500. Okay, so if it's successful, this $10,000 investment would be probably a pretty good deal. If the company ends up being successful, you will get your Aptera for $2,500 less, and you'll have a good investment amount in there. All right, so if you push this sign up to invest, goes to here, and then let's type in, let's pretend like we're going to make an account. All right. Okay, so I think that we've already started. So I'll put in here, Aptera Owners Club. Okay, so once you get in there, it'll ask you for your name. So we'll put, and then we'll say we're U.S. citizen. We'll put in a social security number, date of birth, okay, and then a phone number, let's say that our annual income is 200,000. Net worth is $1 million. And you're an accredited. So there's two kinds of investors. There is accredited and non-accredited. And this, if you go into the FAQ here, it tells you what the difference is. These are SEC guidelines for what an accredited or non-accredited investor is. So here, an accredited investor is an individual who makes over $200,000 a year or $300,000 if you file jointly and has a net worth of $1 million or more, excluding their primary residence. Okay, so then, you know, with this, I would qualify as an accredited investor. And then you just tell them how many shares you want. I think 114 is the minimum. Then you put in your address. Okay, so it's pretty straightforward. You just follow these prompts, and they'll eventually be asked to put in your bank routing number or your credit card number or some way to fund this thing. Okay, so let's figure out how they're valuating the stocks. Currently, the stocks are valued at $8.80 per share. And how do they come up with that? So this is from the Q&A session from back in August. I recommend that you watch this whole thing. There's a lot of information on here. I will link this in the description. But this is where Chris Anthony tells you where the current valuation numbers come from.
So to give you the progression, our first WeFunder round was a maximum valuation cap of 20 million, and then it was 40 million, and then the last round at $3.80 was 200 million, and now the current round at $8.80 is roughly 500 million. All those numbers are rough, but yes, that's that.
Okay, so then the current valuation, they're valuating the company at around roughly $500 million. And that's why they're selling this at $8.80 a share. Before, the previous round was $3.80 a share. And then the WeFunder rounds were 44 cents a share or 88 cents a share. So if you guys got into the WeFunder round, then there's a theoretical on paper appreciation of almost 20-fold. If you got in at 44 cents a share. Okay, and then the next question is okay, now once you have these shares, how can you get money from it? So until there's a liquidity event, and a liquidity event is they go public, they go IPO, or they get acquired by another company. Those are the two liquidity events that can happen. If they get acquired by a company, you will either get money based on the valuation of the company that they're bought out at. So let's say that they're valuating the company at 500 million at this point, and for example, Tesla decides to buy them out and evaluates them at and the agreed upon price for the company is $1 billion. Well, then you would essentially be doubling your money. They would give you double your money. Or usually what happens is if it's a publicly traded company, you have the option of getting stock in the company that acquired you at the value that it's been decided upon. So you would get basically, let's say I invested $1,000 in Aptera right now at $500 million valuation. Tesla buys Aptera at a $1 billion valuation. Then I would have the option of getting $2,000 in cash back from them, or I would get $2,000 worth of Tesla stock, who is the acquiring company. And then the other way that it can happen is that they go public and they have that is their plan, is to go public in about a year to a year and a half. And then they would be on the exchange. And here's Chris Anthony describing how that would happen.
Then you own shares in Aptera, and those shares will sit there until hopefully one day we have a liquidity event or we go public, and then we'll register those shares with a transfer agent, and you can contact that transfer agent to then put it into your TD Ameritrade or Schwab or whatever account to trade on those shares in the future.
Okay, so what happens is once they have a liquidity event, they have a an entity that will have the shares for you, and then you give that entity your brokerage information. So if you have a TD Ameritrade account or a Fidelity account or a Merrill Lynch account, you give them your information, and they will verify it, and they will transfer the stock, the Aptera stock, into your account based on how much you bought. Okay, so that's how it works, and there's two ways. There's a couple of major ways they could go public, and I wanted to briefly touch on that. There is the traditional IPO, and then there's this thing called a SPAC, and then the other way is called direct listing. Dutch auctions are not really used anymore, so direct listing, I believe, is the way that Elio went, and they just basically they go public and they just list their stock. There's no underwriting, and then the market just decides how much it's worth. Coinbase evidently did this. A SPAC. What is a SPAC? SPAC is a special purpose acquisition company, and what it is in order for a company to go IPO traditionally, there is this long drawn out process by which they have to file an S1 with the SEC, and then they have to disclose a ton of information, and they have to go through this long and arduous process. But a SPAC is basically a shell company, and it just holds money. And because it's just a shell company, it doesn't really do anything. The SEC filing is very simple. And then what it does is the SPAC will buy. So if Aptera decides to go public with a SPAC, they'll form a SPAC. That'll hold the money. And then the SPAC will merge with Aptera, which is a private company. And then the Aptera will become a public company. The SPAC will then dissolve, and Aptera will now be a publicly traded company. So what are the advantages of this? The advantages are that it's a lot cheaper to go with a SPAC, and the regulatory oversight is a lot less. So that's good in that it kind of can save Aptera money. And it's much faster. You can do a SPAC in like 6 months or less. If you go the traditional IPO, there's a lot more. The investment bank that handles the IPO will make more money, and a little bit less money will go to the actual company. The process is much longer. The oversight and the filing requirements are much higher. The upside of that is that it is a well-known process, and SPACs, because they've become so popular, the SEC is changing the rules for the SPAC. And they keep changing the rules because it's kind of a newer, more popular thing these days, and they want to try to protect investors. So that's kind of a moving target, whereas the regular IPO is not a moving target. It's very well established, and it lets people see the inner workings of the company much better. So it says here, in worst case scenarios, a reverse merger of SPAC lets a company hide liabilities and business weaknesses that the market would want to know about. So like one recent company was WeWork. Remember, WeWork looked great, but when they delved into it, they found out that it had serious problems, and they went through a traditional IPO, and that's when the weaknesses, the financial weaknesses, and kind of the house of cards that WeWork was based on became apparent. So if you look at the EV stocks, like Rivian decided to go traditional IPO, but like Lucid and Canoo and I think QuantumScape, which is a solid-state battery company, those all decided to go public via SPAC. So you can go either way, and they have pluses and minuses. And I don't know which way Aptera plans on going. I kind of suspect that they're going to go through a SPAC because their CFO has a lot of experience in that. But I kind of hope they go the traditional IPO route, actually. All right, so let's look briefly at their offering circular and a couple of things that we need to look at. So they are doing a maximum of 11,000 shares of stock. If you look at their FAQ, it's like 13,000 shares of stock, and that's because that's including the 3,000 shares they sold in their previous offerings. So total, they have 13,000. They're planning on releasing 13 million shares of stock, which if you do the math at $8.80 a share, that turns out to be $116 million. So theoretically, they could raise $116 million if they sold out their entire offering. And they have 54 million shares of Class A common stock. So what you would be buying if you invest in them is Class B stock. Class A stock is only held by a few people. And if you look here, it tells you which people are holding the Class A shares. This is Michael Johnson Properties Limited, Chris Anthony, Steve Fambro, and then Patrick Quilter Trust holds about 6 million shares of Class A stock. So if you look at this, 15,000 shares represents a little over 27% of controlling interest in the company. And between the two of them, they would control 55%. So that is that's controlling interest between the two of them. This Michael Johnson property is actually, this is a big real estate group out of Orange County. I suspect that this Michael Johnson group are friends of Chris Anthony and Steve Fambro. You know, they're all in that Orange County, San Diego area. And then this Quilter is this guitar amp company, Charles Quilter. And I believe that they're involved in doing the enhanced sound for the Aptera, actually. All right, so they are, I think, very early investors, and they probably gave them some startup funds well before the WeFunder round, but well before they did anything, and that's why they get so many shares. Now, if you look at this, at $8.80 a share, these shares that Chris Anthony and Steve Fambro have are worth theoretically almost $150 million, and that seemed like a lot. So I actually looked up the offering circular for Archimoto, and here's Archimoto's, and Mark Fronemeyer is their founder, and he has 7 million shares in that company, and that's a 55%, which is controlling interest. Current market capitalization is, current value of Archimoto stock is about $10 a share. So that means Mark Fronemeyer's stocks are worth about $70 million. So $140, $130 million seems like a lot, but seems like that is about the going rate for founders of these kinds of companies. It's a pretty good deal if you can start a company like that, it turns out. Okay, and then the last thing that we need to know about is dilution. And this is something I don't fully understand. So this is, now we've converted to the area of the video where I'm kind of speculating, and I'm not 100% sure that I know this is how it works. However, this is the part where they talk about dilution. And if they offer more shares of the stock, then obviously your percentage goes down. So currently, they're evaluating the company at $500 million. And that kind of makes sense because they are releasing 13 million shares at around $8.80 a share, which is $115 million. That represents about 25% of the company. If you look at the numbers, so 15,000 is about 27%, so about 13,000 should be about 25%. So if that's 25, if this is 25%, then you would expect that the total valuation is about $500 million. So that makes sense. So that means if they sell out all these shares, they have no more shares to give out. Okay, and so my suspicion, and please correct me if I'm wrong about this, is that when they go IPO, they will create more shares. And let's say they create, 10 million more shares, or 5 million more shares, or however many million more shares that they create when they go IPO, because they're going IPO to raise more money, and they need to sell more shares to raise more money, because these shares that we're buying now, we've already given them the money. So they're going to need to raise more shares, more money. So if they go and they need to raise like $100 million and they want to, let's say they IPO at $10 a share, they need to create like 10 million more shares of stock. In which case you're going to get the stocks we're buying now at 13 million is going to be diluted almost by 100%. They're going to be you're going to lose, you're going to basically own half the percentage. So if you owned, let's say, for example, I bought out this entire thing. I gave them $115 million and I own 25% of the company now. When they make another 10 million shares and create it and to dilute our share value, now I'm only going to own 12% of the company, not 25%. So that's kind of, I think, how it works. So looking at that, you just kind of have to figure out what do you think Aptera is going to be valued at when it goes IPO. And so if it gets valued at 500 million, essentially if you get in now, you're not going to make any money, and you might lose money if they dilute it too much. So you would hope that they would hit, the market capitalization would be over 500 million. And so how realistic is that? So if you look at, so Lucid has a market cap of 70 billion. So Lucid obviously is a, they've delivered vehicles and their market segment is a traditional car, and people are thinking they're kind of a Tesla competitor. So their market capitalization is very high. Extremely, extremely unlikely that Aptera would reach this kind of market capitalization. So I personally wouldn't count on that. And so I think there's some more realistic comparators. So there's Lordstown Motors. This is the truck company that's using the Elafe hub motors. Their market cap is about 800 million. So if Aptera reaches this kind of valuation, which I think is possible and probably even likely, because Lordstown Motors is valued at this because they haven't even delivered any vehicles yet. I believe if Lordstown Motor actually successfully delivers vehicles, this market capitalization will at least double. That's my guess. And then there's Canoo. Canoo, you guys know they make that kind of funny looking minivan truck, a modular looking vehicle. Their market cap is 2 billion, and they also haven't delivered any vehicles. So, and that's kind of, they have kind of a niche market as well. And here's the Sono. This is the German solar car. Their market cap is like 900 million. All right, so that's, I think 1 billion is like kind of where I'm thinking is a sort of a realistic initial IPO market capitalization for Aptera, is my guess. Totally guessing. Then on the flip end, if you look at Archimoto's market cap is 300 million, so less. So if Aptera hit the market at 300 million, you would actually lose money if you joined the round right now. And then Electromechanica is about 300 million as well. So Archimoto and Electromechanica solo are at 300 million. Now those are, three-wheeled vehicles. I think that Aptera is a much more compelling vehicle than either one of them. But both of them have delivered some vehicles, and Archimoto is delivering a decent number of vehicles actually. Electromechanica probably delivered only 30. So if they are more successful, I expect their stock to go up as well. But you just have to decide for yourself how much of an upside you think Aptera has when you decide to invest in them. Anyways, oh yeah, I forgot to talk about the tax implications. Obviously, when they have a liquidation event and if you sell your stock or they get acquired and you take cash as the payout, then it's going to essentially be taxed as capital gains. And if you've held it for less than a year, it'll be short-term capital gains. And if you held it for longer than a year, it'll be considered long-term capital gains. But it'll be taxed as a capital gain. All right. So if you guys have any questions, please comment below. Hopefully someone will be able to answer them for you. Again, I'm not a financial professional, so don't have any special knowledge on this. If there's been any mistakes that I made, please point them out to us so that we can all be educated. And if you guys have any further thoughts about this, please comment below. Okay, thanks for watching, guys.